Pomp, my friend, good to see you.
Good to see you as well. Thanks for having me.
Not at all. I'd love to hear what the hell you're up to these days, because you kind of, you closed down what you were doing, pivoted away to a family office, and you're now a man of mystery. All I just see is your motivational tweets every morning, and I'm trying to figure out, okay, what the hell are you up to? Because you're clearly up to a lot, because you're up to no good generally.
Yeah, we got a good amount of stuff going on. So if I really think about, where I've been in my career, I've built companies, I've invested in, probably 150 companies, something like that at this point. And I eventually just got to the point where I said, I want to do something that I can do for the next 20 years, 30 years. And when you take that mentality, you realize a couple of things. One, managing money on the behalf of other people is fun. It's great. But it's not like managing your own money.
Ish.
And, look, it's I feel incredibly fortunate, right? When you first start out, you basically need everyone else's money because that's how you get started. At some point, you just say, look, even if my own money is less than what I could raise, there's certain advantages that it provides. And also it gives you the ability to take certain risks that you may not be as comfortable with other people's money. And it also saves you a lot of time. One of the things that I joke with folks is I get a lot less phone calls now from LPs who are trying to learn, et cetera. I enjoy teaching, but at the same time, sometimes you just want to do investing. So really, the way that we think about the family office is there's two sides to it. One is investing, and then one is building companies. And so we've built a couple of different companies. Some we're talking about publicly, some not yet. But the idea is just how do you build something that is you, and you keep that 20, 30 year time frame. You'll make a bunch of mistakes. You'll learn as you go. But so far, I'm having fun and enjoying it, which is probably the most important part.
Is the media business part of this now? So you're thinking of it like a holding company and the media. And what are you doing with the media business? Because I'd love to hear, because you teamed up with your brothers now. How's that all going?
Yeah, I mean, look, I think that content in some way is you have to do it if you want to operate in kind of the digital world. We've been very fortunate that we had a long time horizon. There was no urgency when I started a lot of the content. And I think that that's probably one of the key things that I've learned over time is when you raise money and you do all this stuff like, hey, let's go. Where's the monthly update? What's going on here? And that's great for some businesses. Like go as fast as possible is a really, really successful strategy for certain types. But it's also a really bad strategy for other types of businesses. And so, I tend to think that the way that we built the content business, we wouldn't have been successful if it had been, go raise a ton of money right out of the gate, go hire 50 people and go. And so that business today has a bunch of different properties in there. And we think of some of it as just like very self-fulfilling of like the podcast I get to just learn. And it's amazing. I get conversations with people.
It's the best job in the world, right? Just sitting down and doing this.
It's funny to talk to you about it because I'm sure you feel the same way where
it's a privilege. It's a privilege.
Yeah. Well, there's people who look. I think I'm pretty self-aware about it. There's people who I probably would have a much harder time talking with in terms of getting a meeting with them or learning from them if it wasn't under the guise of, hey, if you come and you talk with me, then I'm going to publish it to all these people, and you'll get some value out of it as well. So I don't take that lightly. But also through conversations with a lot of people. If you think of the mainstream coverage of this kind of whole new world, I think there's an opportunity to do it from a more native perspective. And so it's less of, interviews one-on-one with people that you would expect in a podcast or maybe something that you guys would do. And it's more kind of news-based, and it's driving at ultimately what is the product that people want today. And if you really think about many of the cable networks, they're closed systems. They think of Bitcoin or cryptocurrencies is a very small part of their coverage. And the people who are talking about it probably don't really understand that much about it, right? There's exceptions, but just naturally, they got a lot of stuff going on. What's going on in the oil market, what's going on in the bond market, and what's that crypto thing. And so we think that there's an opportunity to just invert all that, like go to the open network, go ahead and have folks who understand it. And then on top of that, can you do this for an international audience? And so one of the things about crypto that's very unique is it is a very, very international market compared to finance
globally, right?
Yeah. And so, look, I'm having fun doing it. We'll kind of see where it goes, but being in the driver's seat and not having to go at a certain speed or be forced to hire people or whatever allows us to really experiment with a ton of different things. And some of it will work, some of it won't. But at the end of the day, as comes with when it's your own money, you get the benefit, but also you take the risk. And, there's definitely been some things I've, experimented with. And I'm like, man, that was a real fast way to burn some money. But, but it's all part of the game and it's fun that way.
So talk to me about where you are in the Bitcoin world right now, what you've been looking at, whether you've been investing in stuff yourself or, what's your attention there in Bitcoin?
Yeah, Bitcoin is, I think, in a really unique place. If you almost thought of maybe pre-2017, that was kind of the first season of Bitcoin. It went from completely unknown to at the doorstep of kind of initial mainstream adoption. And that frankly happened without many people paying attention. Politicians weren't paying attention. Regulators were kind of aware of it, but not really paying attention. Nation states didn't even know what Bitcoin was. Financial institutions were laughing at anyone who was, dabbling in it, all that type of stuff. I think 2017 was the start of maybe season 2. And you can go 2017 through 2020. And the way that I think about that is you get, some more mainstream awareness. You obviously get the 2017 bull market, you get the crash, you get a whole bunch of this stuff. And that was good for Bitcoin. But it was, maybe like a continuation of season 1, just on steroids. So more people, more of the same, just bigger scale. 2020, I think, was the start of what I call season 3. And I think we're still in season 3, but there were some major, major changes, and they weren't obvious right out of the gate. So, you can look at simple things like the removal of career risk on Wall Street. Paul Tudor Jones, Stanley Druckenmiller, these folks coming out and saying, hey, I'm putting this in my portfolio. Portfolio managers across Wall Street now say, well, I can do it and I'm not going to get fired if it doesn't work because guess what? PTJ did it, right? And these other folks. So I think that was a big part of it. On top of that, I also think that the holder base is changing and their behaviors are changing. And so historically, people who were buying Bitcoin, they weren't macro traders. They weren't in tune with interest rates and kind of the whole financialization of the asset. Instead, they just treated it as a reserve asset. And dollar cost averaged into it. And you can see, very, very non-correlated pretty much up until 2020. But now with about 2 years of data, you look and Bitcoin's been very correlated to NASDAQ and some of these other risk type assets since 2020. And so, if you use that kind of season analogy, season 3 brought in new players, but those new players don't act like the old players. And some of that's good, right? It's kind of like...
Yeah, it's probably capped the downside because if this was a bear market, it would have been down 85%, but it's down 50% because we got different buyers.
Yeah, and I just think about it like when you're playing minor league baseball, there's some people who are good, some people who aren't. Now you're in the big leagues, right? And that's not a knock against season 1 and season 2 participants because they're still here, right? That's the key piece. They didn't leave. You're just now bringing in, these quote unquote major league players, and they got a lot of money, right? They got a lot of experience. There's good and bad with their participation. So, November, December, they hear interest rates. What do? They start selling. Right. And they're very much thinking about this as a risk asset. At the same time, to your point, drawdowns are probably tampered a little bit and we're in pretty good shape. And I think that what we're doing is probably, I don't know, maybe this season lasts 2, maybe 3 years. So, maybe we're halfway through heading into, towards the end of it. And this idea of season 4, I think is when this becomes a full blown consensus trade outside of Wall Street. So season 1 and 2 was contrarian to consensus among retail. Season 3 really was going from contrarian trade to consensus on Wall Street in terms of financial institutions, hedge funds, et cetera. Season 4 is when you now get public companies, nation states, large energy producers, et cetera. And I don't know if there's an end to season 4. Maybe at some point we can come up with, okay, there's season 5, 6, 7, whatever. But it feels like season 4 then is you have now infiltrated the major organizations and entities globally, and they all are convinced that the value's there. We see some of it happening now. Exxon, ConocoPhillips in the energy world. They're kind of doing some pilots. You've got El Salvador and the nation states. But when all of a sudden every sovereign wealth fund is like, of course we have this, right? Every public company is like, of course we have this. Central banks around the world are like, we would be dumb not to have it. That to me feels like that's a different season than the one we're in right now. But, you can see line of sight to it and it'll happen. It's just a question of when do we get there?
Yeah, I think the same thing. I think it is a no-brainer asset for sovereign wealth funds, right? They look for these long duration assets that outperform over time, maintain the purchasing power over time. So, people talk about the correlation of Bitcoin and it's like, well, it's correlated with the financial markets. Yeah, in the short term, but when you zoom out, it's not because of the performance that it has over time. So, it never worries me. I kind of ignore it because it depends what your time horizon is. If you're a hedge fund, your time horizon is the kind of business cycle time horizon. But for the rest of us who own it, it's like we don't really care because over the long run, it just outperforms all of these just because of the very nature of the asset and where it is on its adoption curve.
I think that's right. And the other piece of this too is I've got this like mental framework of Bitcoin is a 21st century asset. And the reason why I think that's important is for many of the same properties that other assets have, Bitcoin is just the modern version. So, maybe the easiest example to talk through it is like real estate. Why do people buy real estate? Well, some people buy it because of hard asset and the depreciation of the dollar. Some people buy it for cash flow. Some people buy it for tax advantages, whatever. But when you actually look at, let's say, the hard asset component, Bitcoin is probably a harder, sounder asset than the actual real estate itself is. You don't worry about, is this neighborhood hot this month and next month it's not. You don't worry about San Francisco, New York real estate was great from a commercial perspective. Now, we got some questions.
Yeah, and you're
right?
not paying for maintenance costs. People forget about that.
Yes. And so, it's a 21st century asset. Another way to think about it is it's an asset light asset, which sounds kind of crazy or somewhat meta. But same way that, Uber is the biggest car company, but owns no cars, and Airbnb with no hotels. Bitcoin in some way, there is no physical atoms component to it of the asset. Now there's mining and there's ways that you can play it also otherwise. But I do think that that's a really important part here because what it does is it provides the exact same things that Uber and Airbnb provided to people that wanted transportation or hospitality exposure. I think Bitcoin is going to provide that from like a macro asset or a monetary asset in this kind of like asset light manner. And so what that really leads to is this thought process of a 21st century asset that is designed to solve 21st century problems. And I think that's part of this is historically over the last 20 years, investors, for the most part, I think saw these 21st century problems, tons of quantitative easing, tons of just lack of signal in markets because of the intervention, like all these issues that macro traders spend all day, thinking about. They just had 20th century solutions to the problems to choose from. Now you get this 21st century asset and it's like, okay, this may not be the say-all, be-all. It may not be the one-size-fits-all solution, but it damn well solves some of our problems. And that's where I think that entry place of like, okay, career risk gets removed. I now understand this 21st century asset. Let me start to play with it and put it in my portfolio. Okay, that's cool. As Paul Tudor Jones said, like the fastest horse, like he was pretty right, right? And I think that a lot of people are noticing like, all right, this is one of the assets that I need to hold. Now, the big question becomes, are there other 21st century assets that can solve some of their other problems? So if you look at, obviously the bond problem is a huge problem across pension funds and various investors. Bitcoin can solve some of that, right? Bitcoin can solve it from a kind of capital appreciation standpoint and protect you from inflation.
And collateral, right?
Correct. And you start thinking about reserve assets and all this stuff. I think that Arthur Hayes, in a piece that he recently wrote, laid out a really interesting argument for ETH as a bond. And now there's a lot of people who are going to argue, the technical structure of ETH is unsustainable and all of that. And so if you just forget for a second, like, are you willing to invest? Are you not? What's the risk? What's not the risk? What I think that he highlighted more than anything, and the takeaway when I read the piece, I didn't run and go buy ETH because of it, But what I said was, oh, wow, these 21st century assets are going to get slotted in to solve the 21st century problems that people have in their portfolio construction. And so, you have to ask yourself, like, hey, how are you going to allocate your capital? What are you interested in? Are you doing it for economic gain? Are you doing it because of intellectual curiosity? Whatever. But I do think that institutional investors are sitting there saying, like, all right, what is that digital asset that I can put into my portfolio to solve these problems? Now, one thing that I think you and I have talked about in the past is this isn't necessarily a new phenomenon, right? If you go back to the, maybe the 70s and 80s, all assets were analog. So if I wanted to buy a stock, I called up my broker in the open outcry method, and they went and bought physical stock certificates. And the first investors who realized, like, hey, I want to buy the same asset from the same counterparty, but I can use the internet to do it, and I don't have to call that broker. Maybe I get better pricing, better execution, whatever. I still have the same exposure to equities. It's just in this new technology form factor. And that led to an absolute, explosion of investment. And the people who were early to that transition ended up benefiting more than the people who were the last ones to kind of catch on. I think that's what's happening right now. Is investors are saying, can I take my electronic CUSIP-based assets and swap them out? And maybe the best way to visualize that is like stable coins, right? If I have a cash position right now and I'm earning, 0 basis points to maybe 100 basis points on my cash in a high inflation environment, I'm sitting there like, what do I do? And bonds aren't providing any sort of protection, except like I'm just screwed. And so I can either hold on and just take it on the chin, or what I think some of the more forward-thinking institutions are starting to say is, what if I take 5, maybe 10% of my cash, I put it in a digital stable coin, and I, go to one that I think is very risk mitigated. So, maybe USDC, where I feel like it's insured and it's got auditing, et cetera. But I can earn 7, 8, 9% on my cash. And I don't have to risk 100% of it because there's still risks that I may not understand, but I've got comfortable enough to put some allocation. And on a blended basis, my 5 or 10% cash allocation to higher yield versus the rest, maybe I can take that 1% I'm earning and can I gross it up to 2, 3, 3.5? Now all of a sudden you start to realize, like, it's still cash. It's still the same monetary policy. It's still being devalued, right? It's just that it's in this new technology form factor. There's a mispricing or a lack of equilibrium in the market between supply and demand. And so you can get those higher yields, but it will get commoditized. And so 10 years from now, if you and I are talking and they're still paying 9% on stablecoins, I will be in awe, right? I'll be like, how are they still doing that? Maybe it happens, but my guess is that it gets commoditized over time. And a lot of that is because now in season 3, these large players, they don't come in with, even $1 million. They're going to come in, and if they see, hey, I can get 9% on my cash, they're going to put, how do I put $2 billion to work and earn 9% with very little risk?
Yeah, I've set up a fund of hedge funds because institutions are coming to me saying, we can't get access. It's just too difficult for us to custody our own thing. What we want is just access to the beta of the market, and there's no ETF, and we want broader than just Bitcoin exposure, blah, blah, blah. So I'm like, well, just invest in the hedge funds because these guys are the experts. They'll figure it out. And so we're starting to see that shift, but they're all coming with, so what's next? Can you guys launch a DeFi fund? Mm-hmm. Because they've all got this yield problem. Now, yields have gone up a bit right now, but over the cycle, yields will come down again over time, and they'll still be searching for yield because they've got this massive pension fund black holes that are out there. And so the amount of money in DeFi today is not a representation of what the hell it's going to look like in 10 years' time. When we go to have this conversation in 10 years' time, my guess is almost 50% of the financial system is going to be in this space.
Yeah, I mean, look, I actually think DeFi is a horrible name to be used to talk about all this stuff. And I get that. I think that's the nomenclature that took off, right? You could argue that like literally changing the way we talk about things has a huge impact. So when folks would call things crypto, and there's a lot of folks like, I'm not super interested in that. You call it Web3, people are like, oh, of course that's going to happen.
Once you got rid of the word currency, it didn't trigger people. Web3 is like, how can I not upgrade from Web 2?
Yeah, exactly. So I do think the way we present this stuff is important. Now, with that said, I actually think of this all as just automated finance. And the reason why that's an important kind of nomenclature is that, one, nobody thinks automation's not going to happen, right? I think everyone's like, yeah, of course it's going to be automated. If you think of Bitcoin, I think of Bitcoin as an automated central bank. It simply is written into code, and it's going to operate that monetary policy in an independent, predictable way, which is the holy grail of a central bank. And actually, the world is going to have to cave to the monetary policy, not the monetary policy constantly changing to address the world. And some version of people or some portion of people will find that valuable. Now, when I think of these other things, sure, some of it's going to be decentralized, but a lot of it's going to be centralized. And I think that's maybe one of the big critiques that like the Bitcoin community has of DeFi. It's like, oh, it's not decentralized. Like, okay, let's just assume that that's correct. That doesn't mean it's not valuable. It just means it's not decentralized.
Sure.
And so I think that when you start to look at machine to machines transacting, historically, they've transacted information. And so that's really communication. And when two machines are communicating with each other, you need digital information to be sent back and forth between the machines. Now what we're getting is this idea of them transacting economic value with each other. The problem was when you were doing information, we digitized the information and then it could, fly on the rails, instantaneous for free. Well, we couldn't actually have automation in finance between machines because all the assets were electronic CUSIPs with multi-day settlement times. It was super expensive, hours of operations,
Different
geographic arbitrage. Yeah, all the problems that people are like, yeah, of course these are issues. Now, if we digitize those assets and forget for a second where it happens. Does it happen on top of Bitcoin with Taro? Does it happen on ETH, somewhere else? Like, just forget that for a second. If we digitize the assets, now machines can actually whip this around the world, instantaneous, for free, 24/7, 365, and machines start to actually transact in an automated fashion. Like you and I literally could sit, we could be hammered, we could think for weeks and weeks and weeks. We will never come up with all the ways that this is going to impact the world and how big it's going to be. Right. And so I think a lot about, again, some of it will be decentralized, some of it will be centralized. That's not the debate. The debate is actually non-automated versus automated.
And I have this debate about the centralized, decentralized. It's like, it's great. You have a choice. If you really want the security of maximum decentralization, opt towards that. And if you don't, opt towards the other, and you will probably you'll probably get higher yields for taking more risk, and that's great.
Yeah, and I think a huge piece of investors who are looking at this space is you have to be very careful, very, very careful to evaluate the technology and the people, but not necessarily evaluate the tribalism. And one of the things that I always go back and forth is like, if we go to the most extreme example, there's people in every single tribe that'll yell and scream scam and fraud and all this stuff, right? Sometimes they are right. Other times they are not right. And what ends up occurring is that these terminology is used so often that they lose meaning. And so naturally what ends up happening is, let's say, the Bitcoin community will yell and scream at other things, say scam, 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 just because it's not on Bitcoin. And then other communities will yell and scream at Bitcoin and they'll be like, lightning's vaporware or whatever. And what you end up finding out is like, we have to remember we're building technology. And sure, there are always bad actors in the finance world, in the business world, and in this crypto world. But for the most part, the things that quote unquote fail, it's no different than if I started an equity-based company, I went and I raised money and I tried to build something and it didn't work, right? And so I think that investors in kind of season 1, season 2, they were very prescriptive because it was possible to do it then. The infrastructure wasn't in place. Consumer behaviors hadn't changed yet. There was a very specific type of user. They were all early adopters, and they all really cared about decentralization and security. I actually think that what we're going to find is that there's going to be tons of centralized automated things that are built using various pieces of technology. And one of the words of caution that I have for the entrepreneurs that are building this stuff is don't try to appease decentralization, interested people. Like if you're centralized, you're better off just being like, hey, we're centralized and automated than trying to be like, as the regulators would call it, like decentralized in name only. Like decentralization has become a marketing term where you just yell and scream and say you're decentralized and somehow that helps you raise money. I think that as we transition into kind of the end of season 3 into season 4, people are going to say to themselves, no, we need decentralized options. We need centralized options, as you mentioned. And the accuracy of which you describe your solution is going to be really important. And so there is a really interesting world where you start to see Bitcoin now being used on like the Terra ecosystem
That
as
was
this
fascinating,
collateral.
right? That was my idea of, remember I came up with this pristine collateral idea, and here is its perfect use. It's like, thank you. This is what it should be used for.
So there are a lot of people in the Bitcoin community that are real mad that I keep talking about this, but the framework I use is Michael Saylor created the playbook for public companies to adopt Bitcoin on their balance sheet or in their treasury. And some of it is the actions he took. Some of it was the severity of his conviction. And then a lot of it was the way he communicated it. So if Michael Saylor had come out and just said, hey, I'm buying Bitcoin because I think it's going to go up, a lot of people have been like, well, that's kind of crazy. But instead, he described very kind of accurately, hey, we have a problem. We went and we analyzed all these different solutions. We chose this as the solution. We believe that this is an asset for our treasury strategy that is not going to interfere with our business strategy. And we now have this kind of dual strategy, kind of approach. And I think it resonated. It resonated with institutional investors. It resonated with other public company CEOs and CFOs. And he created the playbook. And then to his credit, he open sourced it. And he went and he said, hey, we're going to hold these events and we're going to teach everyone else how to do it. I think, and again, we'll see, but I think Do Kwon is in the process of creating the playbook for using Bitcoin as a reserve asset for currencies, meaning that whether you're a stablecoin issuer or a central bank, he is going to create the playbook of here's how you do it. Now, is he going to communicate it correctly? Is he going to open source it? Like there's other things that need to happen.
Yeah, is he going to succeed? We don't know, but it's bloody
Correct.
interesting. I agree.
Correct. And so I think that what we have to be careful of is we can't allow people to, conduct these like affinity scams, right? Where it's like, hey, I'm just using the Bitcoin name and I run and I go do something and every person who's interested in Bitcoin is supposed to say, hey, this is amazing. But I do think that what we have to avoid is everyone running in the second that they have any sort of other asset or anything, just yelling, scam, scam, scam. Instead, what I did was, guess what? I messaged him. I said, hey, I would love to talk about this. Can you please explain it to me? We got on a call. He explained it to me, right? I wrote something about it. I had them check for accuracy. Is this actually what you're doing? Is this how it works? We recorded a podcast episode. I got feedback from people as to like, hey, what are the risks that maybe he doesn't see or he's not talking about? All that stuff. And so when you start thinking about that, it's just like you have to have an open mind. And I think this goes back to the idea of if you think in terms of seasons, season 1 and season 2, you actually could have a very specific view of the world. And if you had a rigid mindset through season 1 and season 2, you were fine because there was a lot of the same stuff that was true. Well, in season 3, let's just use correlations as an example. If you held the conviction that Bitcoin was a non-correlated asset, your mind's in a little bit of a pretzel right now because you're like, well, why is it so correlated to NASDAQ? And so I think you have to constantly be reevaluating things. Now, part of the challenge of investing is you can't go, okay, season 1, season 2, non-correlated, season 3, correlated. And so season 4 definitely is going to be correlated. Because guess what? We may go back to non-correlation, right? To your point. And so you constantly have to be checking yourself. And I think that there's a thread that Alex Leishman from River recently had where he basically said, look, the earliest people to this community, which they came through Bitcoin because that was the only asset around, they were the most open-minded people and they remain open-minded. And so whether they consider themselves a Bitcoiner, an Ethereum, kind of community member, or a Solana, whatever, they constantly are looking at what is everyone else doing because they're trying to learn. And I think a lot about this idea of like velocity of learning. If you were to ask me, what is a group of people in the world that does a great job of learning and they're willing to change their mind when they get new information? It's actually the hedge funds. Like the hedge fund managers, probably more so than any other group, more than the venture capitalists, more than even entrepreneurs to some degree. They constantly are data-driven. They are testing their hypothesis. They will cut trades, literally on a single piece of information. They will press trades on a single piece of information. And they have this like very clear structured way of thinking. And I think that in the crypto, industry in general, we could use a lot more of that because the second you get kind of the hubris of like, oh, I know what's going to happen, as we saw with 100K, I was as surprised as anyone we didn't go to $100,000.
Me too.
But
yeah.
In hindsight, makes a lot of sense, right? And so I think we just got to be real careful to not say, hey, I've been around for a while and I know what's going to happen.
Do you think that these communities, and particularly the hardliners within the communities, are starting to soften and realize that this is a much bigger thing? That it's bigger than their one ideology, whoever they may be, that it's a whole group of ideologies that comes, and technology, it all comes into one thing.
I don't think that the hardliners are softening. I think they're being diluted. And what I mean by that is, so take Bitcoin. 100% of people who owned Bitcoin in 2011 owned just Bitcoin, right? So they were basically maximalist in terms of action. Now it's only 13%. So 87% of Bitcoin holders hold some other asset as well. That comes from Grayscale's Bitcoin investor survey. And when you think about that, that's very different data point than what you would expect based on the public narrative.
And, even from a year and a half ago, 2 years ago.
Correct. And so I think that if you were to survey the Ethereum community, it's probably a really big percentage as well, maybe even more than 87%, maybe even higher, yeah. Right? And you kind of just go through the whole thing. And so in the future, my guess is that 13% is going to be under 5%, and then it's going to be under 1%. And it's not necessarily because they're softening, right? There's a lot of people who say this is the only thing that's valuable in the world. But the whole idea of maximalism is you have a zero-sum mentality. This is valuable, everything else is not valuable. And I actually think that if you look at many of the most influential people in, let's say, the Bitcoin community, they don't have a zero-sum mindset. They actually have very much a positive sum, or like this abundance mindset, where they say, I don't know if other things are valuable or not. I'm just focused on this one thing because this is my intellectual, kind of energy goes. And that's a very nuanced difference, but a very important one. And ultimately, what I think we are watching is as more and more people come into the industry, you're going to get a dilution of the hardliners just simply because the pie is going to grow in size and the hardliners are going to remain a certain number. So while many people will say, oh, I think Bitcoin maximalism is becoming more fervent, it's growing. It's actually opposite based on the data. And again, like, people don't get excited when I say that. That's not my personal opinion. That's just data from a survey. And so I think over time, what we are going to see is the early adopters. They're the ones who tend to be the most principled. They tend to be the ones who are kind of the most irrational from there's a low probability of this working, but the possibility is a huge payoff, right? In terms of like kind of your traditional venture capitalist. As you move into mainstream adoption, these people show up and they're like, oh, this sounds like an interesting idea. I'll put 1% of my assets into this. 100%, there's no way. And so they just naturally are less extreme in their views. They're less extreme in their actions. They're more kind of risk averse, et cetera. And so that leads to diversification, right? We don't expect the average American to have one investment or two investments. We expect what they do. They index, right? Or they use a financial advisor, et cetera. And so I think, again, it goes back to this idea of seasons. The people who are coming into the industry are very different than the people who are already in. And that further enforces the kind of mindset that you have to keep checking your perspective because the ground underneath you is changing. Not necessarily good or bad, but it's changing.
I've never seen the ground change so fast as in this space, right? You think for a short period of time, you think, right, I understand what's going on. And then like 3 weeks later, you're like, I'm so far behind. I don't know what the hell's going on. Everybody's moving ahead without me. How do you deal with that? Because it's really hard.
Yeah, well, so part of giving all the outside capital back that was uninvested meant that I don't have to worry about that anymore. Right? I
intellectually, it's interesting, right? So you can't stop it.
So that's basically what I do is I don't worry anymore about like, oh my God, I have to find every deal because, the opportunity cost means that if I don't get in that deal, I may not be able to raise money in the future. All the things that go into kind of a fund manager and their constant pursuit of like, I have to have the single best returns because it's a competition, for the next fundraising cycle. Now I just go where my intellectual curiosity takes me. And what's unique about it is I used to deploy capital at a very, very fast pace. And the idea was, small checks and then double and triple down on the best opportunities. And you build a heavily concentrated portfolio, but it's done by really wide open, kind of top of funnel. And then over time you concentrate. Now, I don't know, I've gone, 3-4 weeks, no investing. Why? I didn't see anything that I personally was interested in. And somebody told me this. I don't want to use their name because I'm not sure they'd be comfortable with it. But they said to me, I only make investments in people that I'm really excited to talk to again. And I thought that was such a simple framework of just like, if you get really excited, whether it's you're learning or you're watching somebody or you want to support somebody, whatever, those are the things now that's when I invest. And so when you use that as your framework, you may go a long time without finding something that you want to invest in. And then you may find 10 things in a week that you want to invest in. And so what it naturally does is it leads into this other theme that I think is happening, which is if you were in crypto broadly, maybe 2018, 2019 or earlier, you could be a generalist across all sectors. Sure. And you didn't need to be specialized in NFTs or in DeFi or in liquidity pools or in Bitcoin or whatever. Now it's growing at such a rapid pace and it's becoming so fragmented that the quote unquote industry is now like 10 different sub-industries. And so you see the funds doing this. They now have a DeFi lead. They have a NFT lead, whatever. And I think as an individual, naturally people are going to have to kind of focus or concentrate. Where are you going to spend your mental energy? Because if you try to do 1% of everything, you're going to be really bad at all of it. And I think that that's natural. That happens in every market. But again, this idea of we went from season 2, now we're in season 3. Well, now generalists aren't going to be as successful as they were before.
Yeah, and that's why I started the fund of funds, because I can then allocate amongst different hedge funds who have different experiences.
Correct.
So that guy does market neutral, that guy does DeFi, that guy does arbitrage, because it's too complicated for any of us to deal with anymore. I know what my focus is. My focus is more on the kind of Web3, social tokens, NFT side of stuff, but that's just my focus. Other people are, as you said, deep into DeFi, talking language I don't even understand, And that's it's amazing.
If you went and you looked at some of the best innovations and or returning assets over the last, 5 years, right? Let's use 2 examples. So if we use AMMs as one example, I recently had Tom Farley on the podcast, who is the incoming CEO of Bullish, but was previously the president of the New York Stock Exchange. And what he talked about was
you and I are on that interview together on Bloomberg.
Yeah, exactly. So we did the Bloomberg thing as well. But what we were talking about was this whole idea of he actually launched, I think it was like coffee contract or something, right? It's like some kind of esoteric instrument. And the biggest problem was whoever was going to be the first one to make a market there was going to lose a bunch of money. And you had to lose the money to then get liquidity to then make money. And that was a really hard sell to a lot of folks. And so the reason why he's so excited about the opportunity he has now as the incoming CEO of Bullish is they're basically take this idea of an automated market maker, which was pioneered in DeFi, and try to put it in a more centralized kind of regulated wrapper. Does it work or not? I have no clue. I have no thought process in terms of is that a good business opportunity or not, or is it a good investment? But if you think about that idea of an AMM now can be used for decentralized exchanges, centralized exchanges, and if we fast forward, I don't know, maybe there's a 50-50 probability whether every exchange, including in the equity world, will have an AMM in the next decade. And so you start like, wow, that's pretty crazy. And so then if you actually go and you look at another kind of innovation, or let's do a financial return. So Solana went up from 4 cents to $250, which sounds literally insane, right? You had to be absolutely out of your mind. I mean, the guys at Multicoin were out of their minds. They invested, right? And I gotta say, we were out of one of the funds, a very small LP in that first venture fund. And I remember they first started talking about this stuff. We were like, what are you talking about? Like, I don't even understand what you're saying. And I would hear them explain it to other people, and other investors were like literally like, Kyle, stop telling me about it. Right. So like this whole idea of like, oh, everyone knew is complete nonsense. Those 2 guys absolutely should get way more credit than people give them, because it was a courage to act, but also a deep conviction, even when it was unpopular with everybody else. And so the thing I take away from both of those is like, if you went and you asked a legacy exchange CEO, hey, have you ever thought about making an automated market maker? They're like, it's impossible. It's not, that's stupid. That'll never work. Well, somebody went and pioneered it, and now all of a sudden it'll get integrated. If you went and you talked to fund managers about Solana when it first started, they're like, that's crazy. There's no way that's going to work. And these are people who are focused on the industry. So now what I think, which has always been true in venture, but in crypto is on steroids, is you have to look for the things that have nearly 0% probability of working, because that's where all the asymmetry is.
My best example of this that I think has shocked everybody, and I haven't checked the maths, but I think they're right, is Bored Ape Yacht Club holders who bought it on the initial mint made more money out of that in the shortest period of time than any other asset ever. As far as I'm aware, it was 230,000% returns. And that's in a year and a bit, because what they got was these other assets. So if you said, I'm buying a monkey JPEG, which is not particularly exciting to look at, and I'm going to make 230,000% returns in a year, we'd have said you're fucking mad.
Yeah, and this is a really interesting part of the analysis, right? So I always I think of Bitcoin as the reserve asset for the internet. I think of the Bitcoin community as sitting kind of on a pedestal, in the sense of there are many, many people in the Bitcoin community who are not interested in the economic gain. Now, they understand that they will make economic gain, right, by holding Bitcoin, but they are not trying to optimize, how do I make as much money as I humanly possibly can? Instead, what they say is there's a humanitarian aspect, and there's an intellectual curiosity aspect, all these other things. And so I think that's very virtuous. I think that's
and very valid.
Just like it's very, very good. I think there's a whole bunch of other people who say, like, that's amazing, but I don't belong to that church, right? I belong to the church of like capitalism, and I just want to make as much money as possible. Neither one is right or wrong, right? It's just you're optimizing for two different things. It's obvious to see where they're going to disagree on certain issues based on what they're optimizing for, but also I think that you can respect the other side and understand what they're doing. And so if you look at this capitalism kind of pursuit of just how do I make as much money as possible, it actually has been do completely insane things that no one thought would work, like buy the monkey picture, right? And part of that is you were essentially, again, it wasn't you're investing in a company. You were investing in a community, or like this thing that no one really understood. I don't think anyone was like, oh, I'm going to invest in this asset, and then there's going to be airdrops and this and that. And like nobody thought that stuff. And if they tell you that, they're lying, right? But what I think ends up happening is crypto ends up being a buy now, learn later market. And that absolutely turns off 99.9% of people who hear that. They're like, that sounds like gambling. But I think that
sounds like VC investing, early stage.
Well, I think that it is rooted in math. And so the math and the conclusion that I've come to is that in early stage venture, I'm going to use generalized numbers, but directionally correct. 50% of your investments go to zero. 25% you get some of up to 1x your money back. 15% you'll get 1 to 5x your money. 9% maybe is 5x to 10. And then 1% is 10x or more return. So if you look at the dispersion of returns, 50% is zero, 1% is 10x or more, and there's a bunch of stuff in between. In quote unquote crypto, in these tokens, if you are investing in the earliest stages, it's inverted. 50% are 10x or more, 1% goes to quote unquote zero. But there is no such thing as bankruptcy and running out of money and all this stuff because they have a treasury. And the other thing that happens is in venture, if you invest in the seed round of a business, everything looks great for the first 6 months, right? They're hiring people, they're doing product development, they're doing customer development, et cetera. The first cohort of failures in the startup world, they run out of money in 12 to 18 months and they kind of fail. If you unlock the second round of capital, you now may succeed, or you may have attrition at the 36-month mark, right? And you kind of continue this, and after each round of funding, some people fall off, and only the best companies make it to kind of the promised land. Well, in crypto, what these founders are doing is they're just taking the thing, quote unquote, public in the first 6 months. And so they raise money, and then it's liquid, and it completely changes the capital markets and the return profiles, et cetera. And so when you think about that, there is a different risk return profile in this kind of super asymmetric, low attrition market compared to even traditional venture, which is obviously compared to like small businesses or anything there. And so in some way, the investors who were built to do well in venture are actually not necessarily as well built to do well in crypto. And so when you look at the best investors in the crypto ecosystem so far, they got a way different approach than the traditional venture capitalists do. And so naturally what I think will happen is some venture capitalists will understand this and they'll kind of transition their style and strategy. But I don't think you're going to see that many people go backwards. I don't actually think you're going to see that many crypto investors then become like traditional venture capitalists. Let me go invest in equity. And so that's like a really interesting thing, because what you basically do is you have a one-way door to more and more early stage investing in this ecosystem. And if there's capital and kind of low-hanging fruit or kind of white space for people to go after, I think that we're just at the precipice of this like massive explosion of innovation and experimentation.
Yeah, because that's what it drives, right? It allows you to innovate at scale, experiment, fail fast, move on, in a way that the traditional VC model, because you're always dying a death until you get your next capital, because it takes that while before you survive or die, the S-curve moment. But the S-curve moment is over from the beginning in this.
VCs who've gotten a bad name in kind of the crypto land, sometimes rightfully so, sometimes probably they get blamed for stuff that they shouldn't, go back to this idea of let's change the nomenclature. They're not venture capitalists, they're risk capital. And if you want to start something, historically, you couldn't go to the local bank and get a loan to start a super, risky technology company. You couldn't go to your friends or your parents or your classmates or anybody. They were like, this is insane. There's no probability of this working. Like, don't even try it. But there was this special group of people who had risk capital who they said, what's the craziest idea you have and I'll give you money. And so that actually was a key ingredient, not the only ingredient, but a key ingredient to the explosion of the technology industry was the fact that people were willing to risk that capital. Now, what we have is the democratization of that in a very unique way, right? Bitcoin, for example, raised no venture capital money, has no CEO, no marketing department, no any of this stuff. It was funded by, quote unquote, the crowd. There are developers who get grants. There are miners who go and they build their own businesses. There are holders. There are node operators. There's all these kind of market participants that make Bitcoin successful. But there was no venture capital. And that's a very, very unique new thing that doesn't mean everything will be like that. But it also means that now there are multiple opportunities or options in capital markets for people who want to participate in this industry. And I think that's a net positive. Like, I think the more opportunity there is for capital, the more experimentation that happens, which leads to more innovation.
I think this is a really big idea. And I don't think we yet understand what this means. Right?
Yeah.
We've completely changed. At what point in the risk cycle do we take risk? Who can take that risk? How much risk you can take, because you don't have to be, the minimum investment size. You can put $5 in, it doesn't really matter. As soon as it's liquid, it becomes public and tradable and more liquid earlier on. I mean, I think it's game changing in ways I haven't even thought about. I think you're onto something really, really important here, that it's literally changing the face of risk taking.
There's also a inverse relationship between size of investment and asymmetric possibility, right? Is maybe the way to think about it. So the more asymmetric something is, the less money you have to put into it in order to have a return that meets your criteria of like, this is worth it. And what that means is in kind of the Bitcoin crypto ecosystem, there's so much asymmetry that actually people can write smaller checks and then make many, many more of them. So in some way, you get more funding for various ideas. Everyone puts smaller checks, and then the asymmetry makes up for those smaller checks, which is what you've seen in many of these opportunities where they're, anytime you have thousands of X in gain in something, you didn't have to put a lot of money to work to be able to get a big return. And so I think that is, again, to your point, I don't think we fully understand this yet, but the same way that venture capital led to this like Cambrian explosion of technology startups and kind of the world ran and said, oh my God, technology can solve so many of our problems. I think we're at the start. We haven't really fully realized this yet, But when you start to really crank up how much experimentation can be done globally, because you also have expanded the pie of who can participate, I think that it's just a net positive for the world. Now, along the way, there's going to be bad actors, there's going to be scams, there's going to be like all the risk, right? Like there's tons and tons of risk. But it goes back to the idea of this is risk capital. I don't think there's many people who, I don't know, take NFTs, right? Forget decentralized, centralized, a good one, a bad one, whatever. If you buy 10 NFTs and you think all of them are going up 100x, you're a moron, right? But if you say to yourself, hey, I'm gonna buy 10 of them and I think maybe 2 will end up working and 8 will go to 0 and they're gonna be completely worthless, then like you sound just like a venture capitalist sounds. I'm gonna build a portfolio of assets, some will work, some won't, like whatever. And so I think that we just gotta be real careful of people who are preaching that everything's gonna work. We need that healthy skepticism, but also understand that the economic incentive is buy now, learn later because of asymmetry. As that asymmetry gets arbitraged away and commoditized, that will change. And then you will get to a point where there's no longer buy now, learn later. Now it's, what is the equivalent of the discounted cash flow? And how should we think about valuations and price relative to value? And then you'll get a whole explosion of, the quote unquote value investor and, all that stuff. It's just these cycles happen, in these asset classes where you just happen to be at the very, very early stages of it. And so the idea of value investing is so far, put off that people aren't thinking about that.
So let's assume that most people don't get a look in the pre-token side, right? Because that's still a closed club. So,
correct.
There's new participants in it, people like Delphi Digital and whoever. They're not traditional VC. But let's say relatively early stage tokens that are listed. How do average people figure out, because everything sounds amazing. This is why I don't do VC and I don't look for these 100Xs because everything sounds amazing or everything sounds stupid. And usually everything I think stupid does really well and everything I think sounds amazing does terribly. How the fuck are you supposed to do this?
Yeah. So first of all, Delphi, you mentioned, you and I probably have more information than the average person, but I think that they are the single best investors over the last decade in any asset class, point blank, period. And that's a crazy statement. But when you look at what they've done, it's incredibly impressive. One of my biggest mistakes in all of my kind of crypto journey was I actually sit on the board of directors of their research business. And they went to start the fund and they were like, you should invest. I was like, well, you guys never managed a fund before, et cetera. That was very dumb. Like they're stupid, and then there's that decision.
And they've got no investors. You could have been the only investor.
Correct. And instead, I'm just like everybody else and not invested. But which they'll appreciate that I now recognize how stupid I was. But in terms of really kind of thinking through the average person, like they shouldn't invest in any of this stuff. Like, I think that's the takeaway is actually what you should do is you should like go learn about Bitcoin and just dollar cost average into a hard asset, maybe rather than buy real estate or bonds.
Let's assume that the audience watching this are relatively sophisticated.
Correct.
They got their heads around the asset, because I struggle with this as well. It's like, it's really difficult to know because I really would love to do some earlier stage stuff, but I just don't know how to get to grips with it.
I actually think even the sophisticated folks, I have this like kind of decision level that you go through. First is do nothing, buy Bitcoin. Second is, okay, I want exposure to other stuff. Give it to the fund managers, right? Third is buy the blue chips. Fourth is, okay, now I'm going to go ahead and actually do research on this stuff. And when you get into the research, I think one of the crazy parts is you don't know.
And your point struck me earlier, as you said, the things that sound really stupid are probably the better bets.
Go back to the things that are going to have the most value in this are native to the technology. So 2 examples are Uber with iPhones. Uber was not possible for the iPhone because most phones didn't have GPS. The second that the iPhone became a well-adopted piece of technology, now you could have the driver and the rider with GPS on them, and you could have them meet when they actually hit a button. That's a big deal, right? And so the idea of Uber became possible when the native adoption of iPhones was obvious. If you go back to the internet age, there's lots of newspapers that were like, oh my God, the internet got created. This is amazing. Let's PDF our newspaper, put it on in a static website, and anyone in the world could read it. And like, sure, maybe that had some value, but that missed like 90% of the value. There wasn't dynamic headlines, social media distribution, CMSs, multimedia content, like, all the things that ended up making kind of content on the internet valuable. And so I think that what we saw was a lot of those newspapers struggled, and these like new native newsrooms ended up getting ahead. And, there are some newspapers like New York Times, et cetera, who have kind of pivoted and adopted and transitioned well, but there's a lot that ended up going to zero, right? And just being disrupted. So when you look at like what's going to be valuable in the future, that's one of the biggest things. It's just like what's native to this technology. And so if you think of, Bitcoin as kind of the easiest example, because most people will have the most knowledge there, it's just like, okay, if I have a decentralized currency that's an automated central bank, like that's very unique. You didn't have the technology to do this before. Now you do. And so you get the technology innovation and like, what's this unique thing that's now possible that previously wasn't possible? And I think that's why Bitcoin has, such a huge opportunity. But if you then start to think about like all these other things, automated market makers, right? Or lending and all this stuff, like there is a native component to some of this where there's going to be value. The other thing I'll say is not only like, is it crypto native or is it not? The people still matter. And this is actually one of the things that a lot of folks overlook. What does the project do? That's like me showing up to your company and saying like, what do you guys do? And never asking you a single question about who you are, what your thought process is, what's your vision for the future, what's your background? Are you a winner? Are you not? Like all this stuff. Like, no, when you invest in a business, the people are the most important part. And I think that because we think of like, oh, it's decentralized, oh, it's automated, there's protocols, whatever, we forget about the people. And I think that a lot of people would be much better off if they went ahead and they actually still underwrote the individuals themselves as whether it was going to be valuable or not.
So, final broad question is the next phase of mass consumer adoption is unlikely, in my opinion, to be about owning cryptocurrencies per se. It's about the applications layer. Where are you seeing this? Where is the big thing that is going to get the billion people in it?
I love you because I'm going to give you like the softball clip for Real Vision. But I used to say all the time, we're going to tokenize the world. And the whole idea of this was every single stock, bond, currency, and commodity will be a digital asset. And there are a lot of people, specifically in the Bitcoin community, they didn't like that because their whole thing was, it's shit coins, it's scams, it's all this stuff. And my position always was, it doesn't matter where it's ultimately going to happen. It's going to happen. So sometimes it may happen on Bitcoin. Sometimes it may happen somewhere else. And I think for a long time, the Bitcoin community was like, it's never going to happen because all these other platforms are scams. Well, now there's a crossroads. And if we go back to this idea of there's open-minded Bitcoiners and there's not open-minded Bitcoiners. The open-minded Bitcoiners recently came out and some folks at Lightning Labs, Roast Beef, the CTO there, they put forward a plan to launch something called Taro, T-A-R-O. And this is a protocol built on top of Lightning that will allow for asset tokenization, including stable coins and everything else. And so if you said that all tokens are not valuable, are we now going to change our mind and say, oh no, only the tokens built on top of Bitcoin are valuable, which would be a fair position for some people to take? Or are we going to stay with, no, everything built on top of Bitcoin and Lightning is not valuable as well, which again, could be fair. Or when people see it built on top of Bitcoin, will that then open their minds to, oh wait, this may actually happen on different protocols. And oh, by the way, those other protocols are no different than trying to choose between different databases, right? When I'm building any other type of asset. I don't know what ends up happening, and I don't think there's going to be one single solution. But what I do think is that it is very obvious that Bitcoin is using the altcoin market as R&D. And so when it sees something that is working, there is an effort, whether people like it or not, to incorporate that stuff into Bitcoin. And I tend to think that if it makes Bitcoin better, it goes back to this idea of zero sum versus kind of positive sum mindset. If it makes Bitcoin better, then that's good for Bitcoin. You don't need other people to lose in order for you to win. Now, that isn't necessarily going against the idea of you can't call out scams or other issues, but what it does mean is that as we watch this occur, we have to be focused on if asset tokenization occurs on top of Bitcoin, then that is ultimately good for Bitcoin, and that is good for the people who are using those assets, and we should be happy with that if you're in the Bitcoin community, and vice versa.
I think that in the end, we shouldn't care. If I want to send you an asset, I don't care. Like I always say this, I don't know what computer you're on, what telephone network you're on, what software you're running, and I don't care.
I don't like HTTP. I'm not using HTTP anymore. They're scammers.
So I want to send you value. You want to receive value. If you happen to be a Bitcoin developer and you develop that on Bitcoin, good on you. You've created value. If it happens to be on AVAX, good on you. You've created value. That's what's going on. The thing that I think is even bigger than the tokenization of everything, and I've always held that. When I first saw Bitcoin, I figured the entire financial industry is going to this immediately. Immediately, it's actually the slowest thing to happen was securities. I was dead wrong about that. But I've now realized that every single contract is.
Yep, I agree.
Basically, NFTs are unique contracts. And the smart contract technology means that every asset and every contract, that's kind of everything.
It goes back to the idea of automation. Like a smart contract is just code that executes automatically, right? So like at the end of the day, these like quote unquote smart contracts are just a form of automation. A non-smart contract is a really, really inefficient way in comparison to a smart contract. And so naturally the world is going to pursue efficiency, lower costs, faster transaction times, et cetera.
Yeah, and I was thinking about the term, is it automated finance or does it sound better to be just digital finance? It's kind of, but you're right. The how we refer to these things is going to be crucial to make them not sound threatening. Decentralized finance sounds like you are bad, we are good. Cryptocurrency is like, we've got a new currency that's better than yours. Web3, as I said, it's like, I've got to upgrade because I'm on Web2 now.
Look, I think the holy grail, and I think specifically for the Bitcoin community, the holy grail would be if you get assets built on top of Bitcoin, they can fly around the world instantaneously, completely for free. They're secured by the most decentralized, secure computer network in the world at the layer 1. And you can get it into the hands of all these different people. Like that is a grand slam. And we should be laser focused and go and doing that. There's going to be people who build other stuff, right? And if you're in the Bitcoin community, like, cool. Guess what? Somebody today is building a bakery shop down the street. I don't give a shit if it's good cupcakes or not. And like, could I go down there and they say, world's best cupcakes, and I tried and it tastes like shit, and I'm like, you're a scammer. Like, no. And so I just tend to think that like the world is a positive sum. It's abundant. You can have this open mind. Don't be rigid. The world is kind of shifting underneath us. Constantly reevaluate your perspective. And if you do those things, it does not guarantee you that you will be successful, but it will damn well increase your probabilities of ending up and accomplishing your goals. And that's ultimately what people are doing. They just want to, how do I get a couple more percentage points of probability that I'm right rather than wrong? And you're doing all right if you can accomplish that.
There endeth the Pomp lesson. Brilliant, my friend. Loved it. Fantastic conversation as ever. You opened my mind on a whole bunch of stuff I hadn't even thought about. I need to digest some of this as well.
Awesome. Thank you so much for having me. I enjoyed it. And we'll definitely do it again.
Yeah, absolutely. Take care, my friend. Hi there, visionaries. For your free subscription to Real Vision Crypto, that's a free subscription, the world's premier source for cryptocurrency and digital asset analysis is available right now at realvision.com/crypto.